Hello and welcome to John's Client Tax School and my presentation today on income splitting. I'm John Lucadellis, a lawyer in Hamilton, Ontario who specializes in income tax law. Before I begin, I need to insert a disclaimer here. First, it's important to understand that this presentation is about Canadian income tax law, so the intended audience is just Canadians. The presentation is for educational purposes only. It's not legal advice. It's important that if you're thinking of undertaking a tax-driven reorganization or you need tax advice, that you consult with your own tax advisor and not simply rely on this video. So what is income splitting? Well, it's simply methods by which income earned by a family is spread among as many members of the family as possible so as to reduce its overall tax bill. Now, why is this necessary? Well, for two reasons really. First, in Canada, the unit of taxation is the individual, not the family. So we don't tax families similarly based on the income earned by the families, as we'll see in a moment. In addition, we have progressive taxation in Canada, so that the more you earn, the higher the tax rate at which you pay tax. So to illustrate this point about the unit of taxation, let's compare two Ontario families, each of which earns $120,000. But the family on the left has two income earners, the husband and the wife will say, each of them earning $60,000. And as a result of being able to take advantage of the rates applicable to the $60,000 that each of them earns, they pay tax of about $24,500. The family on the right, on the other hand, has one income earner. We'll say it's the husband here. We'll say that the mother, the wife for now, is staying at home with the children. He's earning $120,000, so he's earning the same as the family on the left, but because he's the sole income earner, he's paying tax at higher rates on more of his income, so that the total tax bill is about $34,000 or almost $10,000 higher. Now these are rough figures, by the way. I wouldn't suggest you file your tax return based on these estimates, but they do illustrate the point that the who earns money and how much they are earning within a family makes a big difference to the tax bills. So what we want to do, of course, is we want to average that income among family members. We want to spread out that income among family members. And here's an illustration of the progressive rates that apply in Canada. I've just quoted the federal tax rates to keep this as generic as possible for all Canadian viewers. And you'll see that if you earn under $41,000 roughly, then the federal rate applicable to your income is about 15%. If you earn over $127,000, on the other hand, the rate at which you pay tax on every dollar over that $127,000 is roughly double. It's about 29%. And of course, then we have provincial rates on top of that. There are provincial taxes on top of that. And so in Ontario, for example, the top rate is about 46% right now on ordinary income, interest income, or employment income. For ordinary dividends, that rate is about 33%. The federal personal exemption in 2010 was about $10,300. So anybody earning less than about $10,300 won't pay any federal tax because of that personal exemption. So what does this mean? That means that if a 19-year-old without any income earns, let's say, $10,000 of dividends, that person will pay no tax. On the other hand, if his father, who's already taxed at the top marginal rate, because is already in the top bracket, because let's say the father earns $150,000 of employment income in a year. If the father earns $10,000 of dividends, he'll pay tax of about $3,300. So, of course, this raises the question, well then why not have the parent simply give $10,000 to her daughter, let's say, so that interest on that $10,000 is taxed in the daughter's hands, right? If the $10,000 earns $500 of income, if the parent earns that income, the parent might pay, let's say, roughly $250 of tax on that, whereas the daughter, who's a minor, let's say, doesn't have any other income, the daughter won't pay any tax on that. So that's a good deal, right? Well, of course, the Act has anti-avoidance rules that are intended to stop that. And so what happens is that these attribution rules, as they're called, will treat the income earned by one person as earned by another for tax purposes. So the daughter legally earned that $500 of interest income, but the Act says, well, we don't care about that. We're going to attribute that income to the mother, the parent who transferred it. So a gift of property from, if a parent simply makes a gift of property to a minor child, any income from that gifted property is attributed to the parent. The kiddie tax is another anti-avoidance rule that's meant to prevent income splitting. And what this means is simply is that certain kinds of income, for example, dividends from a private corporation that is earned by a minor, is taxed at the highest rate regardless of how much of it is earned. So you can't use your exemption, can't use the low rates otherwise available to the minor. Instead, it's taxed at the top rate applicable in Canada, and the result is no net tax savings by getting dividends into the hands of a minor child. But that doesn't mean we can't do income splitting. And let's take a simple example to show how income splitting can work. We've got Dr. No here, and he is a doctor in Ontario, and the Dr. No owns all of the shares of PC, the professional corporation that carries on a practice for Dr. No, and he's been carrying on that practice through the professional corporation for quite a few years. The fair market value of the shares of the corporation is $1 million. And Dr. No has an 18-year-old son who is about to go off to university, and let's say the son needs $20,000 for that purpose. Well, if Dr. No simply gave $20,000 to the son, we can safely assume that Dr. No is otherwise subject to tax at the top marginal rate, the top federal bracket. And so in Ontario, that means in order to give $20,000 to his son, Dr. No has to earn really about $40,000 in order to be able to do that. But there's another way here. What we do is we have Dr. No implement an estate freeze in respect of his professional corporation. And if you want to know more about estate freezes, you can see my video on that subject available at this channel on YouTube. So he exchanges his existing common shares for $1 million of special shares. He takes back 80 common shares of the corporation, and his son comes along and subscribes for 20 Class 1 common shares, so shares of a different class that have a relatively small fair market value. The son uses money he earned while working at McDonald's to pay for those shares. So he uses his own money to pay for those shares. And he is now a shareholder of the company. And the articles of the corporation allow the corporation to pay dividends on one class of common shares without paying dividends on another class of common shares. So what we can do is we can cause the professional corporation now to pay $20,000 of dividends to the son, and we can pay those dividends to the son much more tax favorably, because let's say the son doesn't have much other income or doesn't have any other income. If he doesn't have any other income, it might be that he won't pay any tax on the dividends paid to him by the professional corporation. So the professional corporation has paid tax on the income that is paid out as dividends, but the rate inside the professional corporation is probably going to be much lower than the rate that would have applied to Dr. No if he had earned that income. In fact, the rate might be as low as only 15 or 16% in Ontario. And so the earnings that have to be generated in order to get $20,000 into the hands of the son are much lower if we do it this way compared to the position where Dr. No has to earn the money and then make a gift after tax of the proceeds or of the amount to the son. So that's income splitting. We've spread out income. We're taking advantage of the son's personal exemption and his lower rates in order to significantly reduce the tax bill on the amount of money that we're trying to get into the hands of the son after tax in order to allow him to attend university. So this is a very common example among doctors of how we income split. I should note, by the way, this doesn't work for lawyers. Some people might be happy to know, because only doctors and dentists in Ontario are allowed to have family members as shareholders of their corporations. Other professionals don't have that privilege. So that was John's Client Tax School presentation on income splitting. I hope it was helpful.